For those of you who don't know me, my name is Frank O'Regan. I'm the chair of the Finance and Investing Committee, and I'd like to welcome you all to this webinar on investing, the coronavirus, and an Irish perspective on events of late. Just some housekeeping before we start. I want to introduce the speaker. The webinar is being recorded, so we hope to post the webinar to ActiveView after the event, in the event you need to leave sort of partway through the presentation. The questions and answers section will be recorded, and just on questions and answers, there's kind of two options, I suppose, for participants. The first one is that you can submit an answer through the Q&A portal that you should be able to find on your screen. And if you do that, we can try and get to those questions towards the end of the presentation. There's also the option to raise your hand during the webinar, and we're just kind of monitoring if anybody raises their hand and they've got a question. If you do raise your hand, we'll unmute your line. I think everybody's muted at the moment, and you'll be able to answer, open dialogue with our speaker. And if you have registered with your full name, you're considered to have signed in for the purposes of verifiable CPD. So I suppose we can all agree, as we kind of hunker down at home and our social distancing, that these are sort of unprecedented times. And I guess, I suppose in many aspects of life, it's unprecedented, but particularly so for the economy and the investment markets. So we're very fortunate today to have Lenny McLoughlin to hopefully give us a steer as to what the things to look out for, and maybe give us some guidelines in these turbulent waters. So Lenny is a chief economist and investment strategist at Irish Life Investment Managers. He has 25 years of experience in the investment management industry. In his current role, he formulates investment strategies at ILIM and conveys and outlines policy views on assets and markets to internal and external clients. He's managed equity portfolios in all major global regions and the global financial sector. Then he has an economics degree from Trinity College Dublin and is a member of CFA Ireland. So I will go on mute and hand over to Lenny. Thanks, Lenny.
Thanks, Frank, and good morning, everybody, and thank you all for joining us, and hope everybody's keeping safe and well in these strange times, as Frank mentioned. So what I'm going to do through the presentation is just to give a very quick overview of the global economy, and in particular, I suppose, focus on the Irish economy and where the Irish economy currently is in the current environment that we have with coronavirus and restrictions that are in place to try and contain that. And then touch on the Irish bond market in particular, I suppose, in terms of where that is currently sitting and what the outlook is with the changes that we have seen, I would say, on the fiscal side in particular. So with that, we'll just jump straight into the presentation, and hang on one second. And my screen isn't working here. Catherine, would you be able to move to the next slide?
Yeah, just give me 1 second. I need to load up your slide. Just 1 second.
Thanks, Catherine. So this did work in the trial run, so I'm not sure why it's not working now. Thanks, Catherine. And I'll just say when we finish each one and then move on to the next one. So first of all, just looking at the global economy, and we've obviously moved from a position of coming into the year where I would say there was optimism about the global growth outlook, particularly I would say with the progress that we'd made on the trade front between the US and China and on Brexit at the end of last year. And there was a sense that you were going to see a relatively strong rebound in the global economy. And I would say the first number of indicators that we saw in early January were consistent with that and seemed to suggest that growth was actually coming in slightly ahead of where consensus forecasts were at the time. I would say even with the initial onset of the coronavirus, when it emerged in early January, there was a sense that the impact was going to be similar to what we saw with SARS in terms of it being relatively transitory and shallow, and its impact on global growth at that point was only estimated to be a negative maybe 10 or 15 basis points over the course of 2020. So very, very modest. And markets in general didn't really react in any great shape or form, I would say, through most of January and even through February, when the case numbers were contained and seemed to be declining significantly in China in the early part of February. I would say it was only when we saw the virus spread beyond China into Italy and Korea in particular, and then beyond those into the rest of Europe and US, that at that point we saw significant reappraisal, I would say, of the growth outlook. And with that, we've seen, since then, a continuing downgrading of growth forecasts to the point now that the impact of the coronavirus on the global economy is expected to be somewhere in the region of 4.5% to 5% negative growth for the global economy in 2020. So significant changes compared to where we were 2 or 3 months ago. And we have seen the onset of recession in very rapid time across the global economy. Now, I suppose when we look at it, the measures that have been put in place to contain the virus in terms of the various restrictions and activity and movement are the reason why we've had this sudden onset of recession. So all activities, across the globe have effectively been shut, both on the demand and supply side of things. And with that, we've seen a significant reduction in activity levels. Just in terms of some of the hard data that we have seen year to date, and again, I would say there is a delay in some of that data coming through. So for much of kind of March and April, we didn't really have enough or a huge amount of hard data to look at. But now the last 2 or 3 weeks, we're beginning to get those data points through. And just to give you some sense of where the global economy is, in the first quarter of this year, the US economy shrank by 4.8% annualized. The Chinese economy shrank 9.8% quarter on quarter, somewhere in the region of 40% annualized in the first quarter of this year. So significant slowdown. And in Europe, we saw a slowdown in the first quarter, a contraction of minus 14.4% on an annualized basis. Now, the global economy is a little bit out of sync. When I say out of sync, China was obviously first into this, had a very, very weak first quarter, is beginning to show signs of a rebound. And we've seen that in terms of some of the activity data, I would say, for late March, early February, definitely showing activity levels rebounding strongly and back towards 85 to 90% of normal levels. But it's only kind of, I would say, through March and April that we're beginning to see the big hit coming through for the rest of the global economy. So, in terms of the levels of growth that we're now expecting, what I've shown here is kind of, and it's hard to get, I would say, consensus forecasts, but what I've done here is kind of shown the best estimates, I would say, that are out there for growth levels on a quarterly basis through 2020. And in the first half of this year, global growth is expected to contract by minus 18% on an annualized rate over the course of the first half of the year. So this is the weakest growth we've seen in the global economy since the end of the Second World War, if not around the time of the Great Depression back in the 20s and 30s. So significant slowing in growth compared to what we've experienced, I would say, over the last numbers of decades and cycles. Now, there is expected to be a recovery in growth in the second half of the year. That's expected to continue into 2021. And that really is due to start, or is expected to start, with the various restrictions being eased as we're beginning to see across Europe. But also, I would say, the various support measures that have been put in place, both in the fiscal and monetary side of things, are expected to provide the foundations for that strong recovery into the second half of this year and into 2021. Now, even with that recovery, as I said, the global economy is still expected to contract by about 5% this year, is expected to grow by about 6% next year, but that still leaves global GDP at the end of 2021 below where it was in 2019. So that kind of sets the scene, I would say, for the global economy. If we move on to the next slide, Catherine. And I mentioned the various stimulus measures that have been introduced, and I won't go through these in any great detail, but what I would say is that the speed of the response from the authorities has been very, very quick and much more rapid than what we saw during the financial crisis. And I think authorities really learned their lessons, I would say, in terms of the speed of the response, but also the size of the response. So on the left of this slide here, what you can see is the various fiscal stimulus programs that have been announced as a percentage of GDP across various countries. And these are multiples of what we saw during the financial crisis. And just to give you some idea, in the US, we've had packages, I would say, in terms of the initial $2 trillion package, plus additions in the meantime, plus automatic stabilizers, meaning that the fiscal impulse or the fiscal deficit is going to be around 16 to 17% of GDP this year in terms of the stimulus to GDP. Going back to the financial crisis, that was only about 5%. So significant levels of support coming through. And globally, I would say levels of fiscal stimulus are running at around 6 or 7% of GDP. So very, very large. On the central bank side of things, we've seen significant actions there. Rates have been cut to all-time lows. Significant levels of asset purchases have been announced. Again, multiples of what we saw through the financial crisis. And various funding support schemes have been announced. Now, I would say what the authorities are doing, both on the fiscal and monetary side of things, is basically providing a safety blanket for both the consumer and corporates to ensure that they have sufficient income, I would say, to survive this downturn that's going to last for a couple of months, and be in a position of not going insolvent, and be, as I said, survive it, be in a position to be able to reactivate activities when the economy begins to pick up, and therefore, as I said, provide a platform for a strong level of growth into the second half of this year and 2021. And on the corporate side in particular, what they're doing is ensuring that funding markets are open and functional, and that there's an adequate supply of credit to corporates. And on the consumer side of things, or the employee side of things, what they're trying to do is ensure that there's sufficient income being provided for consumers, as I said, to remain solvent and in a position to continue to spend and increase that spending, as I said, when the economy recovers. So that's where the global economy is. That's where, I suppose, the various measures that have been introduced to date have been. I do believe that we will see further measures coming through, both on the fiscal and monetary side of things. Authorities globally have indicated that they will do more if required, so I think we will see more measures coming through. But said, really, I suppose, where we are now, I suppose, is the restrictions are slowly beginning to be lifted. We can see that across Europe. And the key, I suppose, driver, determinant of where growth goes from here will be, I suppose, if the virus continues to be contained and how quickly those restrictions can be lifted and economies reopened again. So maybe with that, Catherine, maybe if we want to ask the first question that we have for viewers. So while people are answering that, maybe if we move on to the next slide, Catherine. So really, I suppose, what we're trying to determine here, I suppose, is people's views in terms of how fast, how quickly we believe the economy will be reopened. But I mentioned, I suppose, those support measures that have been put in place globally, and I suppose beginning to focus now more on Ireland, we have seen a number of measures also introduced in Ireland. And I suppose in particular, I suppose we've seen 3 tranches coming through. First of all, I suppose, has been employee and household and business supports. And I would say particularly this is the pandemic unemployment payment scheme, but also the temporary wage subsidy scheme, which in total amount to over 4 billion. And they've been the main supports coming through on the household side of things. Within those as well, what we also saw was a delay in terms of property tax payment, but also stamp duty and credit cards, and also some mortgage repayment forbearance as well. We also saw some tax and rate forbearance for businesses. In terms of the 2 billion package there in the middle, that mainly relates to direct supports for the health sector. And the last $6.5 billion that I have here was measures announced over the weekend. And now these have been proposed, but they haven't been implemented yet. The government indicated that a new government needs to be put in place for the legislation to be passed for these additional measures to actually be implemented. But what these entail is, and again, this is probably a replication of what we've seen elsewhere, which hasn't been in Ireland to date, but forms of credit guarantees for corporates, but also capital injections and also grants to help restart businesses once the economy reopens again. So in terms of the total size of these support packages introduced in Ireland, in total they're just over 13 billion, or will be just over 13 billion, which is just over 4% of GDP. Now, just on the fiscal side of things, and I will touch on this later on, the fiscal deficit in Ireland this year will be just over 7% of GDP, and that really reflects, I suppose, some of those other automatic stabilizers that we have coming in, but also the slower revenue side of things in terms of the government finances because of the slowdown in growth. So all in, I would say that the fiscal stimulus in Ireland is on a par with what we're seeing globally, probably slightly below what we're seeing across Europe as a whole, where the fiscal deficit is probably going to be around 8.5% of GDP. But I do think we will see more coming through in Ireland as well. So Catherine, if we move on to the next slide.
Sorry, Lenny, I'm just going to reshare. It seems to stop working on my side as well.
Okay. Thanks, Catherine. So looking at some of the data points in Ireland, and I suppose the thing to note about Ireland in particular compared to other countries is that hard data comes through later in Ireland than it does in other countries. So we are quite reliant, I would say, at the moment, mainly on sentiment surveys. We do have one or two hard data points, but mainly the sentiment surveys are kind of a guide in terms of where the economy is. And first of all, looking at the left of this slide here, the purchasing managers indices, and some people may be aware of these. These are surveys that are done at global corporates on a monthly basis, and they basically ask what the outlook is for their business going forward. And the way the PMIs are constructed, anything above 50 suggests the economy is going to expand, below 50 the economy is going to contract. And you can see that the Irish PMIs over the last number of years have been relatively high, well over 50, and in a European and global context have been above average, which has been consistent with the strong growth that we have seen in the Irish economy. Now, we did see a little bit of a dip in those at the end of last year related to Brexit uncertainty, but towards the end of last year and beginning of this year, they did begin to rebound back towards the highs that you've seen in recent years. But more recently, they plummeted, as you can see here, to new all-time lows. And just to give you some sense in terms of where those levels are, the composite PMI currently is 17.3. Remember, again, 50 is the kind of threshold between expansion and contraction. So consistent with significant levels of negative growth in the economy. In terms of the manufacturing side, it is doing better than the services. Manufacturing is currently sitting at 36, services at 13.9. And we see this globally, whereby the services sector is the most hard hit by the shutdown that we've seen today because of the impact in terms of consumer spending, the labour market, and how that feeds through the service part of the economy. On the right of this slide here, what I've shown is the Bank of Ireland Pulse survey. So similar to the PMI, it kind of tries to determine where sentiment is across various parts of the economy. The Bank of Ireland Pulse survey has only been in existence since 2016, but you can see a sharp fall similar to the PMIs in the last month or so. And again, just to give you some idea in terms of some of the figures that we're seeing coming through from these, in the PMIs, I would say between 70 and 80% of companies are talking about lower levels of activity. 80% are indicating they've seen lower new order levels. 40% are suggesting they're considering laying off staff. In the Pulse surveys, 25% of companies are suggesting they're thinking about laying off staff. 60% of consumers are saying they're holding off on spending because of the uncertainty. 27% are worried about their ability to repay mortgages. 55% expect house prices to fall. 45% are worried about pay cuts. So all those things combined do indicate that the outlook for the consumer side of the economy is quite weak. So if we move on to the next slide, please, Catherine.
Sorry, Lenny, this is Frank here. I think we've got a question from Damien.
Yeah.
I wonder if you want to unmute Damien's line.
Good, Damien, go ahead. Hi, Damien. No, maybe we'll just move on.
Okay. So if we move on to slide 6, Catherine. Thanks. So I mentioned we have very few hard data points in Ireland, that cover the period since the virus became an issue for the economy. One of the few that we do have is retail sales. So what I've shown here on the left is what's considered core retail sales. That's excluding the auto sector, because the auto sector, I suppose, has been distorted to some extent by the issues in sterling and in terms of purchases of cars across the border. So to get a kind of truer reflection of retail sales, what people tend to look at as core sales, which is ex-autos. You can see the growth levels here on year basis going back over the last year or so. And typically, I would say over the last numbers of years, we've seen retail sales grow in the region of 5 to 6% on a year-on-year basis consistently over the last number of years. Now, the most recent figure that we have has shown that dipped slightly into negative territory. This is for March. And I suppose the restrictions only began to be put in place in the second half of March. So it does give some indications, I would say, of the weakness that you're seeing currently on the retail side of the sector, which is likely to continue for a few months and worsen, I would say, in terms of the current or the next number of readings coming through. Just in terms of headline retail sales figures, just to give you some idea in terms of where that is. Again, for March on a year-on-year basis, that was very weak and was down over 11% year-on-year, the weakest figures we've seen in a number of years. So if you look at consumer confidence on the right of this, you can see that consumer confidence has dipped substantially back down to the lowest levels that we've seen since the financial crisis. Now again, consumer confidence towards the end of last year was obviously negatively impacted by Brexit, as you can see in the chart. We did see a rise, a recovery in consumer confidence towards the end of last year and beginning of this year. But again, with the developments that we've seen in terms of the labour market in particular and the uncertainty in terms of where the economy is going, consumer confidence has fallen sharply. And again, that would suggest that the outlook, I would say, in terms of retail sales and consumer spending is quite poor over the next couple of months. If you move on to the next slide, Catherine, please. So I would say a key area that we do see weakness globally coming through is obviously the labour market. Now again, I would say we haven't seen too many signs of this in terms of the headline figures in Ireland yet, but just to give you some sense in terms of how the various restrictions globally are impacting labour markets. In the US, over the last 6 weeks, we've seen initial unemployment claims of 30 million being made, which represents about 19% of the labour force. So effectively, over the last 5 to 6 weeks, you've seen 19% of the US workforce apply for some form of benefit payment, which again just highlights, I would say, the numbers that have been laid off. I would say across Europe, the increase in unemployment is not as great as what you've seen in the States because of the way the subsidy schemes work. So what corporates have tended to do is rather than lay off people, they have shortened working hours and have also been able to obtain subsidy payments from the governments. But from the data that we have seen across Europe, about 15 to 20% of the workforce across Europe is receiving some form of subsidy or shortened week work-wise. In Ireland, looking at the left of this slide here, you can see that there's been a very, very slight modest pickup in unemployment in the latest data, rising to 5.4% from 4.8%, but that really understates the impact that we're likely to see when we get the next number of figures coming through. And on the right hand side of this slide here, what I've shown is just the take up of the two main subsidy schemes that have been implemented by the government to help the consumer and employees through the crisis. So we've had the pandemic unemployment payment scheme and the temporary work subsidy scheme, and you can see the numbers here here in terms of the take-up of both those schemes. In total, over the last 5 to 6 weeks, we've seen 43% of the workforce in Ireland make claims under these two schemes. And again, it just gives an indication of the pressures that have been evident in the labour force in Ireland. In terms of where unemployment is likely to go in Ireland, now not all these people who've applied for this scheme will remain on it for long periods of time, nor are they fully unemployed. Some of them may still be working part-time or being paid some form of subsidy while they continue to work. But the expectation is that unemployment in Ireland will peak at some point over the next couple of months around 20 to 22%. Again, compared to the 4.8% that we hit earlier this year, very, very weak labour market. There is expected to be an improvement as we go through the second half of the year, so that for the year as a whole, unemployment will probably be somewhere in the region of 13 to 14% on average, and in the kind of low double-digit areas by year end. But nevertheless, significant weakness in the labour market coming through in Ireland, as we're seeing, I would say, elsewhere across the world. So maybe if we move on to the next slide, Catherine, please. So moving from some of those hard data points into forecasts for the Irish economy and in terms of where the economy is likely to go over the course of 2020 and 21. What I've done here is just shown forecasts from the Department of Finance, which were done towards the end of April. Now, I would say, in terms of visibility around forecasts, it is very, very hard to have much certainty around any forecasts, over the next year or two. And this goes back, I would say, and was highlighted by the US Federal Reserve only 4 weeks ago, where they refused to give any forecast for 2020 because they said there just was so little certainty and visibility in terms of the outlook for growth that they didn't give any forecast at all. Now, what we have seen, I would say, over the last 5 to 6 weeks is various forecasts coming through for the Irish economy from the likes of the ESRI, the Central Bank, the IMF and the OECD. Now, their forecasts have been probably a little bit more optimistic than the ones I'm showing here from the Department of Finance. They did come through or were made earlier. The Department of Finance, I suppose, has had the luxury of being able to see what has been happening in the global economy and the Irish economy in terms of the data points that they have over the last numbers of weeks. And as I said earlier, the actual economic outturn globally and in Ireland has been worse than initially expected. So hence, in terms of the forecast that you're seeing from the Department of Finance, they're forecasting a negative growth in the Irish economy of 10.5% this year. And in terms of the employment data, you can see them there. We kind of touched on them earlier. The fiscal deficit I mentioned earlier as well, and that at the average inflation rate, you can see actually negative rate of deflation or negative inflation in Ireland over the course of 2020. Now, 2021, the expectation is, as globally, that you will see a rebound with GDP rising 6% next year for the Irish economy, a recovery in the labour market, and also an improvement in terms of the fiscal position compared to where it is this year, and positive rates of inflation. But nevertheless, in terms of the Irish economy compared to where it was at the end of 2019, that will still leave the headline GDP figure lower at the end of 2021 than it was at the end of 2019. Maybe we move on to the next slide, Catherine, please. And maybe just digging into some of the details and individual sectors a little bit deeper in this slide here, in terms of some of the most important categories within the makeup of the economy. And looking at, I suppose, consumption first, and you can see consumption is particularly weak over the course, or expected to be particularly weak over the course of 2020. And we can see this already, I suppose, ourselves, when we look, at the level of spend that's in the economy at the moment. It is very, very weak. There's only certain sectors, I would say, that are receiving any types of revenues. Anything on the discretionary spending or leisure side of things has basically seen revenue grind to a halt. It's probably the food area and grocery area in particular that are doing well. It's been estimated, I would say, that spend on that side has probably doubled over the last 5 to 6 weeks. But elsewhere, we've seen a significant hit to consumption. The figures suggest that personal consumption probably contracted by 5% in the first quarter, by up to 25% in the second quarter. Now, again, with the economy expected to reopen, consumption is expected to recover through the second half of the year. The other thing I would say that would support consumption towards the second half of this year and into next year is just the savings rate. So we have seen the savings rate rise. It's expected that savings in Ireland for consumers have risen from about 11 or 12% at the end of last year, probably to a peak of about 19%. And that provides or will provide some kind of a buffer to help boost consumption going through the second half of the year and into next year. In terms of government consumption, and again, I'll touch on the fiscal side a little bit later, but government spend is obviously going to be greater this year than last year, which is a positive, and kind of dip again in 2021 as the government spending kind of pulls back a little bit. Investments are very, very weak. The expectation is that through the second quarter, investments will probably contract by about 70%. Most corporates are probably just completely reining back on investment or capex spending at the moment, just given the levels of uncertainty that are out there. You can see the construction sector in particular is completely ground to a halt until the middle of May. So again, the hit on the investment side of things, just given the general levels of uncertainty, and I would say in particular, I suppose, and also a contributing factor here is probably access to funding, which is difficult. Investment is going to be particularly weak over the course of this year, with a rebound in 2021, but still of the major areas within the economy, it's the one that's kind of expected to get back to the 2019 levels last in terms of the major areas of the economy. On the export side of things, probably a little bit surprisingly to some, given the open nature of the Irish economy, exports are only expected to fall by about 7.7% this year. Again, probably most people would have thought that Irish exports would be hit more than that. The reason that the impact is less is because of the defensive nature of Irish exports, with pharmaceuticals accounting for about 30% of exports in Ireland. But also, I would say medical devices also been quite large within the overall export base. And as a result of that, the hit or negative hit to exports is probably less than many would have expected, with the rebound anticipated, as I said, in 2021. Maybe if we move on to the next slide, Catherine. What I've done here is just give a kind of quick overview in terms of what individual parts or sectors of the economy are likely to do over the course of 2021. And as I mentioned earlier, it's kind of the leisure and consumer discretionary sides of the economy that are expected to be most badly impacted over the course of 2020. You can see distribution, transport, hotels and restaurants, that sector is expected to contract by about 35% over the course of this year. And similarly, arts, entertainment and other services down by a similar amount. You can see construction also down over 20%, but with the construction sector expected to come back online, as it were, towards the middle of May. The impact there is less than those two other sectors that I mentioned earlier. Industry is negative as well, but I suppose in terms of their ability to be able to implement social distancing and some automation within the industry side of things as well, the contraction is probably less than many might have expected. There are three areas of the economy that are expected to grow modestly in 2020: agriculture, information and communications technology. And again, I suppose, given the importance of technology generally just through the crisis and how people are becoming more dependent on it, no surprise there. And then also on the public administration and health side of things, no surprise there, just given the increased levels of spending by the government. And on the health side, you can see that sector too is expected to expand over the course of 2020. But overall, most sectors experiencing sharp downturns over the course of 2020, and that contributed, as I said, to that 10% or 10.5% fall in overall GDP over the course of this year in Ireland. Maybe if we move on to the next slide, Catherine, thanks. What I've done here is just give some indication of where various sectors will be at the end of 2021 versus, I suppose, the base case coming into the year, or the trend growth that has been forecast for the Irish economy over the course of the next 2 years. So looking at the left of here, if you look at GDP, you can see, as I mentioned earlier, by the end of 2021, GDP will still be well below where it was at the end of 2019. And again, it's only through 2022 that GDP is expected to get back to the levels that it was at the end of 2019. And versus the trend level of growth, GDP is well below what the previous base case was at the end of 2021. It's estimated that it's going to be about 15 to 16% behind the previous base case estimates coming into the beginning of this year. Where similarly, you can see, just looking at consumption here, that again, despite that recovery that we're expecting over the course of the second half of this year and into next year, by the end of 2021, 2021 consumption levels will still be about 6% below where they were at the end of 2029 or 2019. So overall, despite that recovery coming through, as I said, it will be 2022 before most parts of the economy get back to where they were at the end of 2019. On the investment side of things, by the end of 2021, it's expected that investment will be about 20% below where it was at the end of 2019. So the recovery there will be slower coming through. But the export side of things will continue to do relatively well. And it's expected generally, given the improvement that you're going to see or expected to see in the global economy, and with that flowing through to the Irish economy and exports generally, that by the end of 2021, exports will have recovered back to where they were at the end of 2019. So the best part of the economy in terms of the smallest hit and the quickest recovery will actually be the trade side of things. So we move on to the next slide, please, Catherine. And maybe with that, maybe Catherine, if you can put the second question in terms of Irish expected growth, if you can put that poll question out, please. Okay, so just in the interest of time as well, maybe I'll move on to the next slide that you've opened here, Catherine, as people answer that question. Sorry, go back to the previous one. Sorry, Catherine. My apologies. Yeah. So just on the fiscal side of things, you know, I mentioned earlier, you know, the packages that the government has announced in terms of the various support measures coming through, which are about 4% of GDP, but also, I suppose, in relation. Sorry, is somebody asking a question? Sorry, I thought I heard somebody ask a question. I'll just continue. But in terms of the fiscal deficit side of things, because of the slowdown in growth and the slowdown in revenues and the additional expenditures coming through to fund these packages and also those automatic stabilizers coming through, the fiscal position will deteriorate significantly this year. Now, having done all the hard work in recent years and having managed to actually have a fiscal surplus at the end of 2019 of 0.4% of GDP, which, you know, relative to the rest of Europe, put us in a very, very strong position. With the spending that's required this year, the fiscal deficit will rise, as I said, to 7.4% of GDP. Now, the government have indicated that they will announce a recovery fund, an additional recovery fund to support the economy as growth picks up. That isn't in the figures here, nor is that $6.5 billion that I mentioned last week, or that was proposed last weekend. It is yet to be implemented. So we probably will see the fiscal deficit rise a little bit more from here, probably up close to or maybe slightly beyond that 8.5%. That's going to be the average across Europe as it stands at the moment. Now, next year, as we see the economy recover, as spending is actually reined back a little bit, and the expectation is that spending will probably fall relative to this year by about 2.5% in 2021, but that tax revenues and overall revenues will probably rise 10 or 11%. That deficit will decline to about 4.1% of GDP next year. In terms of debt to GDP levels, obviously, on the back of that increased fiscal deficit and slower growth, debt to GDP does rise from just under 59% last year to 69% in 2020. But again, with the improvement in the growth position and at the GDP level and that better fiscal position next year, debt to GDP will actually fall slightly down to about 69%. And just to give you, some idea in terms of where that is across Europe, the expectation is this year debt to GDP across Europe will be around 100% on the back of all those positions that are fiscal stimulus measures that have been introduced across Europe. So despite, I suppose, the worst fiscal position here compared to last year, in a European context, it is still relatively strong relative to the rest of Europe. So maybe if we move on to the next slide, Catherine. Slide 13 there, Catherine.
Slide 13.
Yeah, great, thanks. So this is the penultimate slide here. So what I've done here on this one is just look at the Irish bond market. So looked at the Irish 10-year yield, which is the blue line here, and then look at the spread on Irish 10-year bonds versus Germany. So Ireland would be perceived as more risky than Germany. So typically the Irish 10-year yield would be greater than that in Germany. But what the green line here represents is the spread of Irish 10-year yields versus German 10-year yields. So, you know, over the last number of years, given the strong growth that we've seen here, the strong fiscal position that Ireland has, we've seen yields fall in absolute terms, but the spreads versus Germany have significantly narrowed as well. And Ireland now is considered, I would say, semi-core, really on a par with the likes of France and others, rather than other peripheral markets such as Spain and Italy, where the spreads versus Germany are much, much wider than those in Ireland at the moment. So up to last Friday, in terms of the actual level of yield in Ireland, the 10-year yield in Ireland last Friday was 5 basis points, so almost zero. And the spread versus Germany has widened from a low of around 20 to 25 earlier this year to about 60 or 65 basis points. And again, in European context, that is very, very low. So again, as I said, that really reflects the positive view that's been held among investors of Ireland in recent years. And to be honest, despite the deteriorating fiscal position, as I mentioned earlier, the relative position of Ireland on the fiscal side of things is still very, very strong in a European context. And with that, we do believe that Irish bonds and the spread versus Germany do still represent a positive opportunity within the bond market across Europe. And again, just in terms of looking at Ireland and some of the details, I would say we're kind of rated A or above by all the major credit agencies now at this stage. The maturity of Irish debt is relatively long compared to the rest of Europe. So the average maturity of Irish debt is 10.3 years. Across Europe is less than 8 years. So again, funding requirements in Ireland over the next couple of years are much, much better than they are across the rest of Europe. I would say the cash position of the NTMA is quite strong. They have about 19 to 20 billion in cash at the moment. Funding requirements this year are relatively modest, and next year there's very, very little, if any, kind of funding requirements for the government. So overall, is that despite that deterioration in the fiscal position, relative to others, it remains very, very strong. And I would say the key fundamentals in terms of some of those metrics that I mentioned just now for Ireland are very, very strong. And hence, we do still believe that the Irish bond market represents a good opportunity for international investors, even with yields as low as they are, and the spreads being very, very tight relative to other peripheral markets. And the last slide, Catherine, please, which is just a very quick summary, so I won't go into this in any great detail. But I suppose in terms of the figures that we've seen, you know, obviously the global economy has entered a severe recession. The expectation is that we will see a recovery in growth globally and in Ireland through the second half of this year and into 2021. Key to how that develops will be how quickly restrictions are lifted and how quickly those supports that have been put in place by fiscal and monetary authorities actually begin to feed through, and what scale of other supports are likely to come through. I haven't mentioned the B word, Brexit. Now that was a big issue last year, obviously given the uncertainty in terms of where the talks are going, and I would say the UK stance in terms of the transition period and that's extension or not. Obviously that is another risk for Ireland at the end of this year. If it turns out that we get to the end of the year with no transition and another no deal position, then that obviously would be negative for Ireland. That would have a negative impact on some of those forecasts that I mentioned earlier. But that, so I'm just very conscious of time, so I'll stop there and open it up to Q&A. And maybe with that as well, Catherine, please, if you could just have the last poll question there, please, in relation to the bond market.
Okay, guess while folks are answering that question, let me just get my answer in now. I'm going to open the floor up to questions, and I think just pop down. I think that we have a question from Jonathan Gould. I'd open up Jonathan's line, Catherine, if possible.
Well, yeah. Okay, Jonathan.
Yeah, can you hear me?
Yes, we can hear you.
Yeah, you see all the sort of shows of the economists on at the moment. They're all and the pundits are all saying, you know, how are we going to pay, all this money back? I'm wondering, really, is there any need to? We managed to raise, I think, 6 billion at about 0.25% just recently. Seems to me that as long as the world takes fairly well coordinated action, why can't the central banks just print all the money that might to get us through this? Interest rates are on the floor. Effectively, as somebody said last night, one of the economists, countries aren't like people. You don't really have to pay this money back. It all gets rolled over. And, it seems to me as long as you get a good coordinated response, that we shouldn't actually need to really pay any of this back. Interest rates are zero and we can make the debts as long as we like. Is there a flaw in that?
Yeah, no, and when you look at what central banks are doing, that's effectively they're opening the door for the fiscal authorities to increase the level of spending, and they've basically said, we will be here to kind of effectively fund what you're doing. So in the US, the Fed has basically said open-ended QE. They're going to do as much as required for as long as is necessary to ensure that the economy recovers robustly. Just to give you some sense in terms of I'm not sure if I mentioned earlier, but the figures that the Fed were buying, they were buying 450 to 500 billion a week in early April, compared to QE programs back in the financial crisis where they're buying 700 to 800 billion over the course of 9 to 12 months. It is phenomenal the amount of purchases that have been done by the central banks. And I said the open-ended nature of the Fed's commitment is basically saying to the US fiscal authorities, whatever you spend, we'll be there to pick up the pieces. Yeah, and what you've seen is it's been replicated elsewhere, maybe not explicitly, but if you look at the UK, and the Bank of England this morning is indicating we'll do more QE, but effectively the increased QE levels that the Bank of England announced back in March basically was 1-for-1 with the level of increased fiscal spend. Japan has been doing this for a number of years. Europe is a little bit different, I would say, and there were some issues raised, I would say, by the German Constitutional Court earlier this week. But generally, as you said, Jonathan, it is a case of central banks effectively saying to the fiscal authorities, you do what you need to do, and we will ensure that there is a buyer out there for the market, not necessarily in the primary market, but in the secondary market. They will be there to ensure that yields don't rise, and that's what they're doing. In Japan, they have yield curve control, whereby the Bank of Japan has said it will not allow the 10-year yield to go above a certain level. You could see that being replicated elsewhere. There's been talk, I would say, among Fed governors of potential yield curve control. They did this back in the 40s and 50s. It's not, an official policy at the moment, but, is it possible that if yields were to begin to rise, that they would introduce yield curve control? I think it is a strong possibility. So overall, we are now in a position where central banks are effectively allowing all this increased spending, and the measures that they're taking will ensure that yields will remain capped and relatively low compared to what we would normally associate with current levels of stimulus being provided in economies.
Is the problem between Germany and Southern Europe that Italy and Spain can't raise money as cheaply as Germany can, and Germany is not prepared to act as a guarantor? Is that basically the argument?
It is. Now, I suppose when you look at the absolute levels that the likes of Italy and Spain are raising money at, it is still close to all-time lows, and their funding position, because of the absolute levels of yields, while debt to GDP will rise, they're not in a position yet, with yield levels where they are, where they can't fund themselves in the market. There has been all this talk, I would say, about potential, joint issuance in Corona bonds. If that were to happen, that would be the case, where the likes of Northern Europe and Germany would take on responsibility for some of these issues, which then would be used by the likes of Italy and Spain. I would say the talk coming through from Germany seems to have softened, I would say, in recent weeks, in terms of then been more willing to consider it. I mean, we're not there yet, but they do seem to be suggesting, the politicians anyway, seem to be suggesting that they would be more inclined to consider it. It's been the likes of the Netherlands, some of the others, I think, which have raised the objections. But I suppose Europe is, coming to the point where, this type of crisis, is probably going to force more integration than would otherwise have happened. And I think Germany, the politicians at least, are kind of pointing in that direction. the German Constitutional Court is a different thing. That ruling that they came through with on Monday, suggesting that the ECB had gone beyond its legal limits in terms of implementing the pre-existing QE programs or asset purchase programs, did ruffle a few feathers. However, there was a caveat in that they said the ECB did not provide sufficient justification in terms of how it considered other options, the pros and cons of QE, and why they thought QE was the best approach to take. I think the ECB will come back in the next 3 months with those justifications, and hence some of the issues that the German Constitutional Court had this week, I think, will then be kind of dealt with. So, there are kind of rumblings around like that which have caused problems. Our own sense is that the ECB remains very, very adamant that it wants to prevent fragmentation. It will do more. And I think the politicians are slowly, they're much lower than the ECB, but they're slowly moving in the right direction. So our sense is that, Italian peripheral spreads, 10-year spreads currently are about 260 versus Germany. We think with moves upcoming from both ECB and the politicians that you will see those spreads back in towards maybe 200, not back to the levels they were at the beginning of this year when they were 130, but we do think there is scope for those spreads to come back in with support from both the fiscal politician side of things and the monetary side through the ECB.
So we could avoid austerity this time, effectively, you're saying?
Now, there will be at some point a need to kind of raise some taxes to kind of help pay back for some of what's been done. But in terms of severe austerity programs, I would say less likely or less need, given what the central banks have said they will do or what they are doing, compared to when we came out of the GFC, when there was significant tightening of belts. I would say, the central banks are making it much easier for the fiscal authorities this time around, I would say.
Thank you.
Okay, brilliant. Thanks for that, Jonathan. We've got 2 questions in, Lenny, actually on the Q&A chat. The first is from Kevin O'Brien. He sent it in during the presentation, and the question is: how do the PMI levels from slide 5 match up to where things were with the global financial crisis in 2008, 2009?
Yeah, so these are new historic lows. So I would say across Europe. So off the top of my head, I think those PMIs probably got down to the kind of mid-30s. We're probably down, in Europe, the kind of the global composite PMI yesterday hit 26. So we are lower than we were through the financial crisis. Now, the thing about this hit to growth, I would say, is that it is much deeper than what we saw through the financial crisis. I mean, the contraction in the global economy in the first half of this year is going to be a negative 18% annualized. The kind of worst quarter is going to be the second quarter, and kind of growth in the likes of Europe and America are probably going to be somewhere in the region of minus 30 to 35% on an annualized basis. We didn't see anything like that in the financial crisis. However, the hope is that with the measures that have been put in place, both on the fiscal and monetary side of things, with the restrictions being lifted and activity picking up into the second half of the year, that while the recession is very, very deep, it will be very short, in that you will have positive growth again by the third quarter. So the expectation is that you will see those PMIs rebound very quickly. And again, just to give you some sense, China, in terms of their PMIs, they hit historic lows in February. By March, they were back above 50 again. Now, April, they've dipped a little bit again because of the weakness that's kind of coming through from the global economy and its impact in China. But we should see recovery coming through, and those PMIs rebounding. But as I said, it just reflects the depth of this current recession, which is very, very severe. But this recession is expected to be very unusual in terms of, 1, its depth, but 2, its length, in that it literally could be a kind of 1.5 quarter event, whereby you're seeing recovery in the third quarter.
Okay, great. Thanks for that question, Kevin. And one in from James Hannigan. The question is, where do you see the greatest pockets of stress in the Eurozone bond market? What are your thoughts on the impact of a huge degree of supply coming at the same time? And is there capacity and demand to receive it?
Yeah. So again, we kind of touched on this earlier, I suppose, with Jonathan's question. So the ECB have increased the level of asset purchases twice over the course of the last couple of months by about 870 billion in total. So significant levels of increase of asset purchases. The sense is that they will increase it again in June. And again, they indicated, I would say, at the policy meeting last week that they would change both the size and composition of the QE program if needed. So again, the ECB is indicating or saying to the market, we see some of the stresses out there in terms of where those peripheral spreads in the likes of Italy and Spain have gone to in recent weeks. They do not want that. They said we will not tolerate fragmentation across the financial system in Europe, indicating that they will not tolerate yields rising significantly versus Germany. So the general sense is that we will see an increase, further increase again in the level of QE in June, and that the ECB, as it has indicated it is doing under the pandemic emergency purchase program, will be able to direct that towards individual markets and assets if they see fit. So with that, while you are seeing stresses, say, in the likes of Italy and Spain, with those spreads at the 10-year level out in Italy at about, I said 260-ish at the moment, we do think those spreads will come back in again. And we think we can see them at around 200. Now that is not, it's not as low as they were at the beginning of this year when Italian spreads were back in at about 130. But compared to current levels, we do think the situation will improve in coming months as you get I would say progress in terms of additional spending or asset purchase from the ECB, but also I think you will, and the politicians, see what's going on, see what's needed. I do think we will see more details which will be market friendly in terms of the recovery fund that they're talking about of 1 trillion to 2 trillion. And I would say some of the kind of aspects of that in terms of them potentially in the form of grants, which will ease some of the pressures, on some of the peripheral markets. So I think some of the stresses that we're seeing at the moment will ease, but will not be or get back to where we were at the beginning of this year.
Okay, fantastic. And thanks for that question, James. Lenny, I think we're probably just coming up on time. We've probably actually gone over a small bit over the 45 minutes I think we'd originally scheduled. So I suppose the first thing is to thank you for such an insightful assessment of the situation and taking us through all that. Certainly learned. It certainly helps me form my views. I'm sure as well too for the other members. So I guess thanks very much for joining us today and leading us through that.
You're very welcome. Thank you for having me. Really appreciate it.
So with that, I will thank everybody for joining. I think there are other webinars sort of scheduled for the coming weeks. So keep an eye out for those on the SAI website. And I will bring the webinar to a close. Thank you.
Thanks.
Thank you, Lenny. Thank you, Frank.